Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime Edition. On Monday's Stock Play of the Day, we talked about DocuSign. Today, we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I am the Senior Options Analyst at Ally Invest. On Monday's Stock Play of the Day, we looked at DocuSign, and I'm going to highlight the chart here, and I think the chart kind of says it all in that. We have a 15-minute chart that highlights where the underlying stock was at on Monday. So this was Monday at noon Eastern time. That's when we taped the Stock Play of the Day. It is a live show on the Ally YouTube channel, so we're dealing with live quotes. And here was the rest of the day on that 15-minute chart. The stock actually traded up going into the close, then once again traded up the next day going into the close, and once again traded up the very next day going into the close. Bottom line is, since we looked at DocuSign on Monday, the stock is up about 7%. We looked at doing a short put spread. This is the short put spread inside the Ally Invest Options Playbook. And it highlights the fact that we're going to sell this put spread for a net credit to the account. That's the maximum that you can make. So all of the risk and all of the reward is driven by selling strike B, which was pretty far out of the money based off of what we saw the expected move to be in DocuSign going into an earnings that's going to be on December 3rd. And then also we bought stock A, which was a less expensive option contract that brought in a net credit. Our whole goal here was that the options would expire worthless. That would be our best case scenario at the expiration date, meaning that the underlying stock would be above strike B. This implies that we're neutral to bullish on that underlying. The best case scenario is that the underlying would go on up and this would expire worthless, and that would be the less concerning option. Or the underlying stock could just stay where it's at or meander down towards that strike, as long as it doesn't finish below strike B by that expiration date. So this will be a short and sweet Stock Play of the Day overtime, and that we'll just look at closing the trade out. There's really not much to do because the stock has made a strong move to the upside. Here we see DocuSign today, once again, up. It's at 221.87. It's up $2 as of this taping. Here's the earnings. This is highlighting the fact that we have an earnings report soon. That's why we have it in red text. It's December 3rd. After the close, they'll be announcing their earnings report. And I'm just going to highlight here, a big thing that we talked about on Monday is that in general, in stocks and also in a lot of the indexes, by looking at the VIX index, the volatility index that tracks the S&P 500 index, we see volatilities just in general are up all the way across the market. So it's interesting to do trades before stocks go into earnings, and that's what we were highlighting here, because we still see a lot of volatility in the shorter term expiration dates. And the hope is, or the thought is, that the stocks will settle down a little bit, even though the implied volatilities are high, waiting for or anticipating that earnings report. And I'm going to highlight that to start with, and that December 3rd is the earnings date. If I scroll down to the December 4th expiration, which means it would contain earnings, and just look at the most at-the-money call option here on the option chain, I see that the implied volatility, which is the very left hand, or all the way over to this side of your screen, 77% implied volatility on that expiration. That makes sense. It contains earnings. There's a lot of risk that's involved with that earnings report. Implied volatility is higher. The expiration we were dealing with, 43% implied volatility. Still a lot of volatility, not as high as the one that contains the earnings report. And that's part of the reason why we were able to go fairly deep out of the money. The underlying stock was at 205 when we looked at this, and some change when we looked at this trade on Monday. And right now it's 221.45. we sold the 185 put. That was the driver of this strategy, and used some of the credit to pay for the 180 put that protected us. If we scroll down to the option strategy workbench, we see that it's now trading for about 9 cents. So you could let it ride if you'd like to. You got a few more days remaining till that expiration date. Let's see exactly. We have 7 days remaining until that expiration date. So if you wanted to let it ride, you could. But at 9 cents, you got to consider just taking it off. Maybe we put a limit order in to try to buy it at 5 cents, save a few pennies more. But when we did the entire trade, we did it for a net credit of 45 cents to the account, or $45 for every 1-by-1 spread that we did, less commission, of course. Okay, so how would we close the trade? Well, if we could come directly from our holdings page, but this is a paper trade. As we always emphasize, they're not meant to be a recommendation. We're just trying to learn here on the stock play of the day overtime edition. And if I click trade, and this was my position and I had it in my holdings, I just have to do the opposite of what I did to get into the trade. So for example, when we first initiated the trade, we sold to open the November 27th 185 put. Then we bought to open the November 27th 180 put. Now, instead of buying to open, that means we're going to sell to close. Instead of selling to open, that means we're going to buy to close. Right now, we see the midpoint at about 9 cents. I'm going to do something different just to kind of, since this is like I said, a short and sweet stock play of the day overtime. Let's look at entering a limit order. Let's say we're going to close this trade at a net debit to the account, and that debit is going to be 5 cents, and we're going to make that good until cancel. All right, so we're saying we would like to get out of the trade. It's trading at 9 cents on the midpoint right now. That's our net debit to the account if we close both legs at the same time. And we're going to be a little bit greedy, and we're going to try to take a nick or another 4 cents out of the trade. We'd be happy to close out this trade if we could just pay a nickel to close it, and then we would move on. So we would want to make that a good till canceled order, saying that this order will persist until we actually cancel it, or up until that option's expiration date, the option contract's expiration date on November 27th. So that's how I would enter a good till canceled order. To close it, I would just click preview order, look at the order, and then send the trade down to the trading floor. Well, that's it for this edition of the Stock Play of the Day Overtime. We'll be back this Monday looking at a new stock play of the day. It's always at noon Eastern time, but you might want to click subscribe and then ring the bell, and we'll send you an alert to remind you. Thanks for coming, everyone, and we'll talk to you soon.